Hi everyone, my name's Corey and welcome to today's video where we're going to be understanding cash secured puts, going over a beginner guide that I've put together for you today. We're going to discuss three main things in this video. We're going to be discussing the basic concepts of what options contracts are. We're going to be looking at the mechanics of what a secured put option contract is using a real life example, including Tesla stock, since it's the most commonly searched stock on the internet presently. And then last, we're going to look at the risks and rewards of puts and options contracts. So let's dive in. Let's look at a definition. Options trading involves the buying and selling of options, which are financial contracts that give the buyer the right but not the obligation to buy or sell an underlying asset like a stock at a specified price. It's known as the strike price before a certain date, which is known as the expiration date. There are four main components of an option contract as well. The first one's going to be the underlying asset involved in the transaction. This can be a stock or another security that is held inside of the contract itself. The second thing is going to be the strike price. That is the price at which the underlying asset can be bought or sold depending on which party you are in the contract or negotiation. The expiration date. This is going to be the date that the contract officially expires, meaning no parties can move forward with buying or selling the underlying asset after that date. And then lastly, there is a premium that is exchanged between the individuals involved in an options contract. Most of the time, the individual who is purchasing the contract has a premium that they have to pay for the opportunity to buy or sell a position to the other party. There are two types of options contracts, a call and a put. A call option gives the holder a right to buy the underlying asset at a strike price, meaning that predetermined price within the contract. A put option gives the holder the right to sell the underlying asset or security at that particular strike price. Well, buying a call option means you expect the underlying asset to go up in value. And by buying a put contract, you would be expecting the underlying asset to go down in value. Now, if you are selling the contract or writing that contract, it involves receiving the premium from the other party. You are not obligated to buy or sell the underlying asset unless the strike price has been hit within the expiration period inside of that contract. Before we move forward, let's talk about leverage and risk real briefly. So an option contract does provide leverage, meaning you can control a large number of shares with a relatively small amount of capital. So one option contract typically represents 100 shares of the underlying stock. Therefore, when you buy an options contract, you are controlling the price movement of 100 shares of that position. This increases the potential for both higher gains and higher losses, so keep that in mind if we are playing with options. A cash secured put option is a more conservative option contract that you can consider. It is a option contract strategy where the investor or you would write a put option on a particular stock while simultaneously setting enough cash aside to purchase that stock if the contract is executed, meaning you most of the time want to utilize this strategy on a position that you are currently ready to buy because you think it is a good price already or you think it's relatively close. Now, a real world example of this would be like you going out and buying a car, but you're hoping to buy it at a discounted price, but we're comparing this to the stock market. Hopefully this real world example will help explain. So as of today, the recording of this video, December 11th, 2023, I've pulled up Yahoo Finance's options contracts down here for us to reference. Tesla stock, I think the market closed at $239 and some change, but we'll just call it $240 for this example as of today. Now, in the event you were wanting to sell a put contract like what we've discussed, the approximate price that those are going for are $26.25. So I've done a little math here if we want to spell it out, but in short, these contracts are, if you wanted to purchase these contracts, the expiration date through these ones that I've got on the screen is through the 12th of January of 2024. Excuse my typo here. With that being said, if the options contract costs $26.25 to purchase, then we are going to be multiplying the premium times the number of shares within the contract. So in the event you wrote this option contract and received $26.25 per options contract, you would receive a premium from the potential buyer on the other side of $2,625. Now, this contract is supposed to execute at $220 per share. So what you have done is somebody has given you $2,625 for the opportunity to sell you shares at $220 within the next month. So there are ultimately 3 outcomes that could happen from this, and we'll go through each of them right now. The first outcome, since I told you that Tesla today is trading at $240, would be that the option contract expires worthless. What I mean by that is the individual that gave you the money, they're not going to call you up today, even though Tesla's trading at $240, and say, hey, I want to sell you my 100 shares of Tesla stock at $220 per share. That would be a losing proposition for them, so they would just let that contract expire. Since they purchased the contract from you, they have the opportunity, not the obligation, to sell you shares at $220 per share. So in this case, in the event that the option contract expired worthless, it means that you get to pocket that $2,625 for free. There's no transaction that took place except for he paid you a premium for the opportunity to execute that contract with you, which now today it's January 15th of 2024, hypothetically, and the price of Tesla never hit $220 per share. So they're not going to call you up and want to execute this contract. Now, if you would have bought Tesla outright at $240 per share the day that instead of selling an option contract on this, your stock would be at whatever price the stock was at, and you would not have earned any premium for utilizing this strategy. Scenario number 2, the option is exercised, but it's exercised at $220 per share. So what this means is that if Tesla stock does drop to $220 per share or less, the person who gave you that $2,625, they might call you up that day and say, hey, I want to sell you my shares at $220, which you are obligated, since you sold them this contract, to buy those shares at $220. So you should have $22,000 set aside for this scenario. However, you did receive a premium of $2,625 for this individual to call you up and consider utilizing this contract. So in a real world sense, you had paid only $193.75 per share for the 100 shares of Tesla stock, even though it's trading at $220 per share. Hence, you kind of bought a vehicle at a discounted premium. You could have paid $24,000 whenever you considered writing this contract in the beginning by just outright buying 100 shares of Tesla. But in this scenario, you actually netted out better because you bought in at a lower price than what you initially had wanted to day one. Again, this is an idea for a position that you are already wanting to purchase because you think it is a good price as it is or very close to it. All right, scenario number 3. This is the worst case, well, not the worst case scenario. This is going to illustrate a scenario where you have risk involved. So with a put option, you are obligated again to buy those 100 shares at $220 per share, costing you $220. Well, let's say Tesla stocks drops to $190 very quickly within the next month. Well, if that individual calls you up and says, hey, I'm going to sell you my 100 shares at $220 because we have a contract that says that I can do so and you're obligated to buy them from me, you on paper would immediately have a $3,000 loss. But don't forget, you received a premium from that individual day one of $2,625. So in the real world, you're only actually down $3.75 per share in this instance where Tesla stock dropped to $190 and this person called you up and said, hey, I want to sell you my stock at that full price, like what we have discussed within our contract. Now, in the event you had bought the stock outright, obviously your losses would be about $50 per share relative to, in this situation, you only have losses of $3.75 per share, or a whopping $375 versus a $5,000 loss if you had just bought it outright. So a recap of that real world example would be option 1 or scenario 1, the options contract expires worthless, meaning you made $2,625 from not buying that position of stock that you really wanted to. Option or scenario number 2, the option is exercised at $220 per share because that's what the contract was written for, the individual gave you $2,625 for the opportunity to sell those back to you at a fixed price in the future, hence $220. If you round out all the math of the premium received plus the purchase price or the cost to acquire those 100 shares of Tesla stock, you're all in at about $193 per share, even though the option was exercised at $220 per share. Now, the third scenario would be is if the stock fell very quickly down to maybe $190, just for sake of an example, your net loss per share would only be $3.75 relative to a $50 per share loss if you had just day one bought the shares of Tesla at $240 in the beginning of this example. Now that we've gone through an example, let's hit on rewards and risk just for an overall holistic view. So cash secured puts can be a very useful strategy for generating income and potentially buying stocks at a discount. However, like all investment strategies, there are risks, particularly if the market moves against your position. It is crucial to understand these risks and manage them according to your investment goals and your risk tolerance. I'll even add in there your financial plans. So first, some of the rewards. The premium income you receive from selling an option is one of the most immediate rewards you receive because it is going to be provided to you day one of that contract. Now, there is also a potential to buy investments at a discount, as we illustrated with that Tesla stock example earlier. That's another advantage. There's also a benefit of a lower effective purchase price, meaning that if you received a premium, it's going to reduce the effective out-of-pocket cost to you to buy that individual investment. So, for example, if you sell a put with a strike price of $50 and you receive a premium of $5, your effective purchase price or cost in that position is going to be $45. There is also some flexibility and control whenever you're considering cash secured puts. This is meaning you can pick the strike price and the expiration date on the contracts that you are interested in looking into. And then lastly, there is a limited capital requirement. When you are selling puts on individual positions, I strongly suggest you have them cash secured, meaning you have the cash set aside for the transaction regardless. Now let's look at some of the risks. Again, the other side of the coin, you are obligated to buy at a strike price in the event that you sell a covered put contract. So if the Tesla stock drops, like what we gave in the example, to $190 per share, you are obligated to pay the $220 per share as what the contract was written as, assuming that happens within the time length of the contract that you have at hand. Now, this is going to limit some upside. So let's assume the stock just runs up from you selling this put. You actually never participated in the upward move of Tesla stock until it drops to a lower price in the future. Now, market risk is another risk that you have involved with this. In the event that the stock declines sharply, even sharper than that $190 per share that I gave in an example, you are still obligated to pay that full price of whatever the contract was that you had written with the other party whenever you decided to sell that put. There is an opportunity cost that could come into play as well, meaning that in the event you are forced into one of those contracts, you could have maybe had the opportunity to invest elsewhere, whereas you couldn't because you had to keep that cash ready to go in the event you were obligated to buy that position. There is also liquidity risk. So options contracts do not always make it to expiration when individuals purchase them. This is another deep dive conversation for a later date, but in short, what you can do is you can sell that option contract prior to maturity to the next door neighbor or somebody else that is willing to pay for that contract, which means that premium that you received might be spent or in the event you want to sell that contract to somebody else might buy that from you early, or you might be able to sell it early is what I'm trying to say here. And then lastly, assignment of risks. There's always an early chance of early assignment, especially if it's deep in the money or if there is a dividend event, which could possibly disrupt your strategy. I hope you found today's video helpful. In conclusion, let's recap real fast. We discussed a definition and the basic concepts of what an options contract is and how it works. We discussed the mechanics of a cash secured put using a real world stock example, Tesla in this case. And then lastly, we hit on some of the risks and rewards of considering options contracts as a part of your financial strategy. Now, I am a financial advisor, but this should not be considered personal financial advice. Please consult with your financial professional to see if these concepts are applicable to your unique situation. If you derive value from this video today, I hope you consider sharing it with a friend or family member who could maybe benefit from the information. And please feel free to subscribe to the channel for weekly updates on certain areas of topics, whether it's investment management, financial planning, insurance products or services. We cover a lot of different topics on this channel to hopefully help build financial freedom. My information will be below in the description of this video. I hope you enjoy the rest of your day. Thank you for your time.